Imagine buying a tiny slice of a building in New York or a fraction of a US Treasury bill, all from your phone in seconds with as little as $10. That's the promise of tokenizing real-world assets. Let's break down what that actually means without the jargon. Tokenization sounds complicated, but the core idea is simple. You take something from the real world, like a government bond, real estate, or even gold, and represent ownership of it as digital tokens on a blockchain. Each token stands for a slice of that asset. If there are 1,000 tokens for a property, and you own 100, you effectively own 10% of that deal in a digital form. These tokens can then be sent, traded, or used as collateral, similar to how you use other crypto assets. Why is everyone suddenly talking about tokenized real-world assets? There are a few big reasons. First, access. Traditionally, things like private credit or commercial real estate were only available to big institutions or very wealthy investors. Tokenization makes it possible, in theory, to offer smaller slices to more people with lower minimums. Second, efficiency. Blockchains operate 24/7. Settlements can happen much faster than traditional systems. This can reduce paperwork, middlemen, and administrative costs. Third, programmability. Because tokens live on a blockchain, you can build rules directly into them. For example, who is allowed to buy, when income is paid out, and what happens if certain conditions are triggered. One of the fastest growing real-world asset categories on-chain right now is tokenized US Treasury bills. In simple terms, some companies hold real T-bills in traditional custody and then issue tokens on a blockchain that represent a claim on that pool. Investors get exposure to short-term government debt, but hold it in a blockchain wallet instead of a brokerage account. Why do people like this? Because it combines the yield from government bonds with the flexibility of crypto rails. You can move your exposure between platforms more easily, use it as collateral in certain DeFi protocols, or settle trades quickly without always going back through a bank. Now for the important part. Tokenization does not magically remove risk. You still rely on the company issuing the token, the legal structure behind it, the quality of the underlying assets, and how well everything is regulated. If the issuer fails or the legal agreements are weak, a token on a blockchain may not be enough to protect you. Also, not every RWA token is the same. Some are fully backed and regulated. Others are more experimental or operate in gray areas. So the technology can be powerful, but the details really matter. Big picture, real-world asset tokenization is one of the strongest bridges between traditional finance and crypto. Instead of crypto being its own isolated world, blockchains are slowly being used as infrastructure to move, track, and manage traditional assets like bonds, funds, and real estate. If this trend continues, you might see more of your everyday investments represented as tokens behind the scenes, even if the front end still looks like a normal finance app. If you want to keep learning how crypto connects to real-world money in plain English, hit subscribe and join the Financial Clarity Club.
In the next episode, we'll look at how blockchain is used for faster, cheaper international payments, and what's actually happening behind the scenes when money moves across borders.